Good day, all. Ira Epstein of Linn Associates with your agriculture update for a pretty wild trading day today. And it is Monday, the 13th of May, 2019, just after 4:30 p.m. Central Daylight Time. Good rally in the wheat and corn, and the reason for that was not how the USDA crop report came out and showing the crops are behind on the new plantings in corn and soybeans, but the export business picked up in these two markets. It did not pick up in the soybeans, so that hurt the market. Dollar went nowhere today, just sort of sitting. In fact, most of the currencies didn't go anywhere with the exception of the yen, which had another bid from safe haven status. Energy markets, even the threat against 4 tankers over the weekend where they claimed they were attacked, did not keep prices up there. So as we're taking a look at soybeans, what did the president say today? He's telling the farmers that he's going back to the year that they had $15 billion in sales, and in some manner, from that high point, he is going to make financial aid available to them. The details of this, unknown. Obviously, he's got to consider his re-election. He needs the farmers, and the American Soybean Association, boy, they are ripping him a new one because they have been literally taking the beating. The other area that's taking a beating too are the meat markets, but we'll get to that in a minute. So beans have gone down from that $9.25 and a quarter high to $7.91. Now in our firm, they had a lot of talk about where the government guarantees, the loan programs come in. The firm here has been saying the 770 level is a very important level. As far as I'm concerned, they were saying that, by the way, about 70, 80 cents ago. Now you're getting down to a zone that you start paying more attention to. You've come straight on down. You left a gap in the chart here. It still hasn't been filled. The question is now, is this market going to try to run back up to fill that, or is this market in trouble again? As we take a look at the swing lines, they are still down. So the pattern of lower highs, lower lows remains. Obviously, the market has been in a state of collapse. It's still well under the 18-day moving average of closes, which has been under the 100-day. Yet a bearish crossover in March. And from then, this market is just, I think, if you will, accelerated to the downside more than most thought it would. Obviously, the trade wars don't help. Obviously, the escalation and no end of this in sight, very important. Now, I just also saw that the president, with the filings they did with the trade representative just moments ago, so I'm telling you news that from this hour, probably broke 5 minutes ago, it appears that June 24th would be the earliest date that additional tariffs of up to $300 billion plus can be put on China. So while the Trump administration sidestepped it today, well, he really doesn't know if he's going to do that or not. He's put the paperwork in place, and that would be the earliest date from the looks of everything that I just saw. So this market's running the lower Bollinger Band. Bollinger Bands, these black bands, often set up trends. The word isn't always, it's often, from sideways action. And in this case, it certainly did its job. Now, the combination of momentum locking in, I use the term embedded. What slow stochastics typically do is gyrate between a 20 low level and an 80 high level. Traditionalists say that anytime you get into the 20 range, which is this red dashed line, you're oversold and the market's ready to rally. Get over the blue line that I've got here, and it's overbought, ready to pull back. I don't look at it that way. I carried it another step and say the beauty of this indicator is it can lock in. And until it breaks out of that, where both the numbers that make it up, the blue and the red lines called the K and the D lines, until the red line gets back over 20 on a closing basis, it adds fuel to the fire by doing what? It's telling momentum traders it's locked in bearish, and it's telling them on rallies, the odds favor that this market's going to run into selling. Does it have to? No. But that's what the indicator does, and at least it's the way I teach it. 836 is the last rally high, but what rules the day is the embedded reading. Meal. The embedded reading rules the day. Now, what you did do today is you got back underneath, as you can see, that lower Bollinger Band, and then you snapped back up and over it. And that's been one of the patterns. You get under, you're snapping back. And why? Because the odds of staying outside of a Bollinger Band are only 5% of the time. However, the combination of breaking out of sideways action and then embedding, just like we had in the beans, that's a powerful combination. And until the red line pops over 20, I'm not expecting that rallies hold. In the soybean oil, you have the embedded reading. You move to the left side and then right back as you should within the Bollinger Bands. Support today found literally right on that band's low, and the market popped from there about 40 points off of it. In the corn market, let's get away from today. As you can see, there are times where you can close under it, but staying under it's a real trick. That's the whole purpose of the algorithm. One of them, giving you an idea where the market should climb back into the band. It doesn't mean you're going to get an uptrend. It means you should get back within the band. Well, the market tried to stay under the band on Friday. Today it even extended that, came back from it. Now you have an outside day up. Does an outside day up turn the trend? No. By the way, this could be called a key reversal day too. Why? When traders use, or chartists use, the term key reversal, it means you've made the extreme move and reversed. In this case, this is the lowest low that you see on this chart in quite a while. And then it took out yesterday's high, Friday's high, closed over that, and at the top part of the day's range. It often leads to price making a run at the 18-day average, which in this case is 362.25. You'd have to take out 368.25 in order to break the pattern of lower highs, lower lows. So I would expect to see an attempt at holding the market back there. Did the market get bullish news tonight in the corn delay of planting? It absolutely did. In the wheat market, again, lower Bollinger Band, hit it. I teach in my charting course that the first time you hit a Bollinger Band, especially after you get up to an 18-day average, that's where I think the pro's going to take some money off the table. Does it also mean that when you do that, you can't leave money on the table? Of course. But then you have other methods to try to come into the trade, such as embedded readings and so on. But if you play the percentages and you look at them, go back and figure it out yourself. My job here isn't to teach you. That's in my charting course. In the sugar market, I'm interested in markets that on a day like today don't follow the herd. This market closed higher. That's interesting. Something I take note of. It still has the embedded reading, so I didn't expect it to go anywhere, and I think the pros are still selling this market into this rally, but I am taking notice that with everything falling around it, it couldn't go down. Coffee market was it wasn't unchanged. This is the 5 o'clock print. Here's the coffee market today, down 120 points. What would I say to you? So far, the 18-day average has offered the resistance, and the Bollinger Band has offered the support. The pattern, the trend is down. Lower highs, lower lows, but a target is here at 87.97. One of these times you'll close over that 18-day average, which you did not do here. And if you can add to that, then maybe the market starts a move that says, prices simply got too low on this hold break. My job isn't to pick bottoms. It's to try to catch a trend. In the cocoa market, you're in a battleground. It's between the 100-day average in green and the 18-day average. The swing line's not helping. It's got a higher high, lower low pattern. Momentum right now is pointing to the downside. The settlement was under the 18-day average, but you can't get a trend going down. You've got that higher high, lower low, and even if you fall down to the Bollinger Band, you're going to keep that pattern the way the setup is. A market that's taking it on the chin is cotton. Our exports to China, T-shirts, all those things, clothing, they're not buying from you. And away this market's going to the downside, bed sheets, think of all the products that cotton's involved in. And a lot of people don't think about that. Retailers got hurt in the stock market today, but people don't realize they've done a lot of stockpiling already. Remember that? So we'll see where that all comes in. In the cattle market, this is a churn sideways that still has a bearish bias because you're under the 18-day average and you're locked in that momentum on the slow stochastics. Until this is lost, I still think the pros are selling this market looking for lower prices. In feeder cattle, until you lose the embedded reading, I still think the pros are selling into these rallies. Lose these readings, by the way, and I would look for price in the 18-day average to try to make a run at each other in each of those markets. But you haven't lost it. And in the hog market, you pulled the plug out from under the market again. This market was trying to get friendlier, but then as these trade talks worsened, as no deal happened, now the odds of, in the near term at least, seeing China buy our pork, nah, they'll get their Smithfield pork because they own that company, but I don't think they're coming into this market right now. But that wasn't our expectation anyways. It was way back at the end of this year, next year, that I'm hoping to see that the deal happens. China needs to replace pork, and they got their herds have been culled by African swine fever. Here you are with my market research. I want to remind you how my research works. I start every morning with a video of 45 futures charts, 5 charts that are ETFs. And in that video, I'm not in it. I've got my mic on, I'm talking, and my charts will look just like this. I'm showing you the different indicators, not only that I have here, but window envelopes and other things that I do. Twice a day, I write a short commentary. I'm not into writing a book. That's not what this is about. It's about telling you tomorrow what the major reports are, what the market's expecting. If there's an event that could be affecting the markets, you go from there. Then, for those of you that use window envelopes, I also include the daily numbers to how you plot them and where they should be, at least as I see it, off the charts. So, if you'd like to try this, why not? If you haven't tried it before, give yourself the free trial. You can call us, go to our website, you'll see a carousel of free offers, click it, sign up for what you'd like. I'm Ira Epstein. You have a good day.